identify the contract. Step 2 is to identify the performance obligations. Now, I'm going to explain to you the concept of performance obligations because you need to understand this. A performance obligation is a promise. It's a promise to the customer. If I have to go to the DEMEC situation, I would ask, okay, I've combined the contract. What are the promises I owe to the customer? I owe him a car and I owe him an apartment. When will I recognize revenue? I will only be allowed to recognize revenue when I discharge the obligation. Yeah? Now let me explain to you the concept of a performance obligation. I'm going to use you as the example for my gift voucher. Amin likes to read books. I want to buy for Amin a book. I don't know what book he needs. I go to Liberty Bookstore, right? I go to Liberty Bookstore and I take a $20 gift voucher for Amin. $20. I pay that to Liberty. Can they recognize the cash? Yes. Can they recognize revenue? I've just bought the gift voucher. They tell me the gift voucher is not refundable for cash. What I then do, I got the $20 gift voucher, I give it to Amin. On the weekend, he goes and he takes a book and he gives them the voucher. Can Liberty recognize revenue? Yes. They can't recognize revenue when I buy it, but they will recognize it when Amin goes and collects. But let me give you another situation. Let's say Amin leaves the gift voucher in his car. He forgets about it. 2 years' time, he's selling the car. Hey, here's the gift voucher Yusuf gave me. He goes there and he turns it around, and it's expired. Can Liberty recognize the revenue? Yes. Yeah? Another situation, I gave Amin the gift voucher, he puts it in his pocket, he sends his trouser to the washing machine. It comes up totally crumpled. He goes to Liberty, they don't recognize it. They say, what is this? Can they recognize revenue? They have to wait for expiry. The point I'm making is that revenue generally would only be recognized when the performance obligation is discharged. And the performance obligation to Amin or to Yusuf would only be discharged if they provide goods or expiry. This is exactly the same concept which airlines work on. You know, if they sell you a ticket and you have points, they will split the price of the ticket between the flight and the points. And they will only recognize the revenue on the points once you redeem the points or the points expire. What I'm saying here, the concept that I'm trying to bring to your mind here, is the way revenue standards have been evolving. You're not recognizing revenue when you're receiving cash. You're not just splitting revenue over time. You are recognizing revenue when your obligation is discharged. Step 2 wants me to identify the obligations. They want me to understand what these obligations are, and then I will account for them accordingly. So, identify the performance obligations. Step 3 is to determine the transaction price. How much am I getting? Step 4, allocate the transaction price. So what you did in step 1 is identify the contract. Step 2, how many performance obligations sit there. Step 3 is determine the transaction price. You did nothing until then. You only start doing accounting in step 4. And what should you do in step 4 is take the transaction price you have and allocate it to performance obligations. And finally, you get to step 5. Thank goodness, you finally get there. You see, the old revenue standard just asked you to measure revenue and recognize it. Step 5 tells you now recognize revenue. There are 2 ways to recognize revenue, either at a point in time on percentage completion. If you want to do percentage completion, you need to qualify for it. There's only 3 circumstances when you can get to percentage completion. Let's use an example. I'll give you a real-life case study with a telco company. So a telco company tells you, listen here, here's a free phone. Here is a free phone for you, sir. Is the phone for free? No. They don't give free phones. Nobody gives free phones. They tell you, here's a free iPhone, but I want you to enter into a 2-year contract with me. Pay me $50 per month. I will give you free minutes. I will give you free data. I'll give you free texts. But sign the 2-year contract with me. My question here is, can you get the free phone on its own? You can't. Can you get the contract on its own? Yes, you could. But in terms of this offering, if I have to apply step 1, and telcos also call it this, they call it a bundle. It's a package. Yeah? So when I identify the contract, I have to look at the bundle. That's my step 1. Then I have to do step 2, identify the performance obligations. Now, how do you identify a performance obligation? A performance obligation, I told you, I gave you an example of a gift voucher on how to recognize revenue on a performance obligation. But how do I decide something is a separate performance obligation? The way you make that decision is you ask a question. Can the customer benefit from an iPhone without the SIM card and the calls and texts? So let's say this is a Vodafone contract. Can the customer benefit from an iPhone without a Vodafone contract? Can they benefit from a phone? Yes. Can they put another SIM card in a phone? Yes. Therefore, the phone has value to the customer and the contract has value. So if I don't like iPhones, I put it in my BlackBerry, I put it in my Samsung. Or if I don't like the iPhone, I sell it. It's like the DEMEC example. They're giving you a free BMW if you buy an apartment. If you don't like BMWs, you sell the BMW. Can you benefit from the BMW without the apartment? Yes. You understand that? So we have 2 performance obligations because the customer can benefit from each of these things on its own. Step 2. Then step 3 says determine transaction price. Step 3 is easy. Transaction price. How much am I going to get? I'm going to get $50 for the next 2 years, $1,200. So up till now, I've identified the contract, looked at my performance obligations, determined my transaction price. Now, in step 4, what I need to do is take this transaction price and allocate it. Give some portion to the phone and give some portion to the contract. What I then do is go to Vodafone's website. On Vodafone's website, they sell the phone for $900. They provide a similar contract with the same amount of data calls and minutes for $600. So therefore, if a customer had to buy these 2 things separately, he'd have to pay $900 plus $600, which is $1,500. But this deal is a good deal. It's a good deal because they are selling me both things for $1,200. How much revenue can I recognize? Can I recognize 1.5 as revenue? No, you can't. You can recognize 1.2. Now, what must I do with the 1,200? I'll tell you. I'll say, look here. For the phone, it's 900 out of the 1,500 multiplied by the 1,200, which is 60%. I need to allocate 60% of the 1,200 to the phone. And therefore, I need to allocate 480 to the service contract. So you know what this means? For the telephone company, although they said it's a free phone, on day 1, they are giving you the phone. Debit receivable 720, credit revenue 720. They have actually sold you a phone. Debit cost of sales, credit inventory of the phone. You understand? And mobile phone companies don't like that answer. Because they're saying, no, my KPI are data calls and texts. But that's the reality. You have to recognize. How much do they invoice the customer monthly? They'll still invoice them $50. But the revenue that's going to be on the monthly basis is 480 divided by 24, which is $20 per month for the contract. You understand this? This is why telcos don't like it. Majority of telcos in the world do bundles. They sell or give you a free phone or give you a discounted phone. What you need to do is allocate the things differently based on this price. Last step, last final step is recognize revenue. So what did I do? I allocated 720 to the phone, 480 to the data calls and texts. When will I recognize revenue on the phone? At T0, the day you sign the contract. When will I recognize the data calls and texts of 480? Between month 1 and month 24. You got it. If you understand how those 5 steps work, you understand the revenue standard to some degree. Look, where will this change what we're doing? A lot of cases, we need to decide and determine whether we have separate performance obligations, whether we have separate contracts. These are all important considerations. And as I told you also, the revenue recognition changes. What I would like to do now is go through, I'll give you an introduction to the standard. I've covered the 5 steps. Some of these steps I'm going to go into some detail. So what's changed in IFRS 15? Let's go through some of the background. Before IFRS 15, I had IS 18, which talked about revenue. I had a construction contract standard. I had IFRIC 13 for customer loyalty programs. I had IFRIC 15 for agreements for real estate. IFRS 15 gets rid of all those guidance. It rolls it up. So you're not going to get a separate standard for